Hello and welcome to FidelityConnects. I'm Glenn Davidson. Tankers, private credit, software, those are just some of the themes top of mind for our next guest. And as US markets remain volatile, he's been taking a more neutral stance as uncertainty builds. So how is his team staying nimble in a fast-moving environment? And what might this mean for investors looking for durability and income today? Joining me now to walk us through how he's navigating today's landscape is Fidelity's Tactical High Income Institutional Portfolio Manager, Scott Mensi. Scott, great to have you here.
Great to be here, thanks.
And just a reminder that today's webcast is offered in live French audio interpretation. Scott, you're normally in Boston or traveling all around talking to investors and advisors throughout North America, but you're here in the studio today. Nice to have you direct and live.
Great. It's great to be here. Done a few of these over Zoom or over the web, but it's always better to be in person.
Excellent. Why don't we start with a reminder to our viewers of the premise of Tactical High Income Fund?
Sure. So Tactical High Income is an income-oriented solution that can invest across the full spectrum of income-oriented asset classes. So what does that mean? That means, well, if you think about most balanced funds, they're investing in stocks and investment-grade bonds. But there's a lot of asset classes in the middle, things like convertibles, preferreds, high-yield bonds, emerging market debt, floating rate debt. And if you look over time, what you'll see is that those asset classes in the middle, those ones that I just mentioned, they tend to outperform stocks and investment-grade bonds 50% of the time. So what we're trying to do is find equity-like returns without having to necessarily own the equities. Doing more with less is was what we like to say. And also those asset classes in the middle, they typically have high levels of income. So we can add a lot more income into the portfolio than a traditional balanced fund, but still give folks that balanced fund profile.
So you've got exposure all over the place, lots at your fingertips, and a huge team really to draw on for all of the information and news and just the volatility that's been in front of us. Now, you and I were both away last week, separate trips, but what we both were talking about before going live is that it was difficult to disconnect from the news, which has
100%.
been so fluid. And now we get here today with even more news just from last night and volatility today as we speak, which may be very different by the time we finish this webcast.
100%.
As someone famously said many years ago, there's known unknowns and unknown unknowns. Can you give us an overview, a context of what you're seeing today based on what the team inputs are?
Sure.
And anything that this gives you a reminder of from the past?
Yeah, of course. So yeah, a lot of things going on. I would say one of the great things about this strategy and what we do a little bit differently is that we always have this great matching of income relative to the duration risk and credit risk and equity risk we have in the portfolio. So that if certain scenarios happen, we should have enough income to help dampen the blow and help us have better downside protection than our peers. And two, we're trying to look for securities where there's bad news priced in. And we talked about all this volatility. Now, where is there a lot of bad news priced in today? Well, what we started to see is that, you look at the stock market today, the S&P 500 is down around 7%. But some of the technology stocks, software stocks, those things are down 30, 40, 50%. So we're starting to look there as potential opportunities. You've seen certain parts of the credit market sell off, but that really hasn't been broad-based. The credit markets have been surprisingly stable over this period. When I talk about credit, I usually reference high-yield credit spreads, the option-adjusted spread. And what we've seen happen is that over time, when we get into a situation where the market's starting to price something, there's an economic slowdown or a liquidity event, we see those spreads get up to around 500 basis points. Today, we've started to stay, we haven't even gotten above 350. So the credit market's been pretty stable, and the stress in the credit markets has been around technology and software. Now, everything that's going on geopolitically, what we like to always say is that with that nice profile that I mentioned, the income relative to the duration and the equity risk, we're pretty stable and have many different ways to win. And one of the areas that's been helping us through some of that volatility during this period has been oil tanker stocks. So that's a way that we had them in the portfolio before this all happened, but a way that we've really been keen and focused in on what's happening with the Strait and how does this impact oil trade.
Adam's talked a lot about oil tankers.
Oh, yeah.
He's the king of oil tankers, I think, among other things at the firm. And perhaps in some minds that was kind of boring in the past, and it's been so relevant. Why is oil always in the forefront?
Well, it's we're transitioning away from fossil fuels globally. A lot of emphasis on green energy, whether that's solar, wind, et cetera. But ultimately, most of the world's infrastructure is built around petrochemicals. So that includes oil, natural gas, et cetera. And when we think about oil tankers, why are they great? Like, well, one, these companies all went through this what I'll call capital allocation shift, where they used to be really boom bust, right? They do really, really well when the economy was booming and oil's moving around the globe. And what would happen is these management teams would buy new ships right at the peak, right? So they did have very good capital management. And what we've seen happen now is that they've delevered their balance sheets. They're making money, regardless of what point of the cycle we're at. And what we like about them is that they're now durable. And if you think about one of the things that we've always said, and part of the reason we like these oil tankers, is that if you look around the world globally, oil moves by these tanker ships, and about 15% of the ships that are out there are from what I would call unsanctioned or sanctioned countries. So it used to be Venezuela, but Iran and Russia. Now, if we ever get peace in the world, and this is why we think the market has been missing, if we ever get peace in the world, there's going to be a supply constraint here on tanker ships. So we saw it already happen at the beginning of the year. Once the situation in Venezuela got situated, Maduro was out, those ships had to become compliant. And that's part of the reason why a lot of these stocks rallied and did really well in the first half of the year. Now it's a little bit different. We still think that theme or that thesis will play out as potentially we get peace at some point. I think in Iran that we'll see more ships, non-compliant ships, come out. But right now it's been a little bit volatile because the market's trying to figure out what infrastructure has been hit, how is it going to move, and we've talked to a lot of these companies, and I'm sure folks have seen the headlines. There are ways to get oil out of the Middle East without having to go through the Strait of Hormuz. Maybe not as much, but there's a pipeline that goes across Saudi Arabia, and there's other ways to get it around. So we still feel confident that there is a misunderstanding of these stocks based on the supply demand of the fleet, and that's why we continue to own them.
And so it was the shadow fleet you were referring to as well, the sort of mysterious one. And that's changed a lot. But we're going to get into all the different asset classes within tactical high income. But because we've gone down the path of oil and it's so topical, let's stay there for a minute. The futures market is very volatile right now, obviously. And whatever's happening in the Strait, which changes so quickly, is dictating that market, obviously, and forecasts. Is it fair to say that if there's a resolution to the conflict that's going on right now, oil shouldn't drop really quickly because now there's a backlog and it's got to now get digested into the marketplace? Do you see that being long-term volatility because of that sort of equalizing out?
Well, I think there's some concern about what's going to happen to inflation, right? Because oil is such an input to basically everything. Think about everything in this studio. There's petrochemicals in it. So that's going to take a little bit of time to work through the system, and that's going to create some volatility because I don't think that's necessarily where the market is focused right now. They're focused on what's happening immediately. So there could be some added volatility there. But again, it remains to be seen what that impact to inflation will be. One of the things that we've talked about, I got a lot of questions about over the last couple of years is like stagflation. And what I always said was that stagflation wasn't an issue until oil prices were high. And here we are, oil prices are high. So maybe that's something we have to think about now. It still remains to be seen because the economy is doing really strong in the US, but that's one of the things that the movement in oil is making us think about. And obviously the production of everything that's happens globally, that's the costs are going to go up. So it will take time to work itself through. But those are the things that we're thinking about.
And this is really important from a fertilizer standpoint as well. There's ships stuck in the Strait, and that has such huge ramifications in the market.
You've seen some countries in Asia start, reducing purchases of gasoline, and there's shortages. So yeah, it's gonna play a role in the global economy.
When what I'd like you to do is remind the audience about the scope of team that's involved and the research that comes to you. One person that comes to mind, and he's retired, David Bridges. He was the ex-CIA who Fidelity had on staff to educate people about geopolitics. And but I believe he's retired. Do you have people like him that you can talk to?
So David Bridges has left Fidelity, but he's still a consultant. So we actually get to talk to him quite a bit. About a week or so ago, I think right before our vacations, he was talking with the folks at Fidelity, giving his perspective. So that's one way we can get this geopolitical kind of view and informed in terms of what's actually happening, boots on the ground there with his connections. I think if you look at our research team, we Adam and I sit within the high income and alternatives group, right? So we're focused on those middle pieces, the high yield, the loans, convertibles, et cetera. But we have the equity counterparts. We've got our investment grade fixed income counterparts. We have our asset allocation team. And we use all of those inputs to try to figure out what's going on. And not to mention our private credit team too, based out in Chicago. They've been really helpful as we think about some of these things outside of oil, like software and what's happening there. So, we have a lot of resources out there to get us in with companies to help us understand what's happening right now. I remember I go back to around the tariff situation last year, and I remember we were talking with a steel company, and the questions were coming in from the analysts. What's happening now? The prices are changing and the markets are moving. And he said, we haven't had one client come and change an order in the last 3-4 months. So things maybe seem like they're moving really quickly on the surface, but you really have to understand what's going on with the companies themselves to make the decisions on whether or not you want to invest. Do we pull back? That sort of thing.
There's a lot of forensic research that goes on
100%.
behind the scenes. Would you say that the frequency of meetings goes up in volatility like this?
For sure, particularly around the areas that are affected. I think, since this all started, we've had countless meetings on what's happening in the Middle East. I can think of several meetings that I've been on with as it relates to software with our, whether it's the private credit folks or the financials analysts who are kind of involved with the companies that are actually purchasing and buying the private credit, to the actual companies themselves and coming in and talking about it. So yeah, there's a lot of forensic research, as you call it. I really like that term, because it's digging in the weeds, trying to figure out exactly what are they saying, does it match what we're seeing, those sorts of things. And all of our analysts are doing that on a day-to-day basis.
How many years have you been part of the Tactical High Income Group?
So I was there right at the beginning. So I helped launch this product with Adam, was that 12 years ago.
Did you ever think 12 years ago, Tactical High Income sounds like we can be really quite, accommodative and aggressive within the market, but it'll probably be pretty cool. and it's just so much more, the marketplace is so much more volatile, but you must appreciate those inputs that you have.
Oh yeah, 100%. The inputs make it possible, right? What we say is, we are a part of this, Adam and I are part of this small boutique in Fidelity. Right. So we have the nimbleness that you need in order to make the decisions to be tactical, but then we have all the resources that allow us to do it in a risk-adjusted manner.
So another hot topic, and you mentioned the team in Chicago that does private credit. Can we talk about private credit? Sure. Your thoughts on the market right now?
Sure. So private credit, and today there was a headline about Blue Owl that was capping redemptions at 5% to some of their funds. The first thing I would say is most of the vehicles within the private credit world are built for this type of situation, meaning when they say Blue Owl is capping at 5%, that was agreed to by these investors when they signed up. And if you look at the private credit world, over time, about a third to a quarter of that market matures every year. So even in the worst of times. So if you think about what's happening out there in the market, there's a natural way for folks to get their money back. Might not be today, but over time, there should be a way to get their money back. But there is issues there. Software is certainly a problem. With the advent of AI and how it can disrupt some of these software businesses, we're going to go from licensing fees and very predictable cash flows based on seats to maybe some other metric on how these companies get compensated. And one of the things we're looking at is what types of companies have the proprietary data that would make them less susceptible to AI disruption and could still have that type of valuation that they command right now. Those that don't, that are accessing public information to create their software, they become a little bit more challenged, right? There's a couple companies in the loan market I can think about where you have a company that pulls real estate data from multiple different public sites and had put it into a package so you could see what was happening in the real estate market. Great product, but all that stuff is publicly available. So you could see a situation where there would be somebody developing something that's a lot cheaper because it's public that would put pressure on that business. So those are the types of things we're thinking about now in the private credit world. But ultimately, it's just, it's only about 10, 12% of the broadly syndicated loan market, about 20% of the private credit market. So it's something we're watching pretty closely. But when we think about these companies and you think about private credit, it's a long business, right? We're lending for 3 or 4 years. So things don't happen overnight. right? We have to see what's going on and make those decisions that way. And what I like to say within the sub-investment grade world is that melting ice cubes can be good investments. It's just you have to be there before the ice is gone.
Exactly. And you talked about software earlier in our discussion. Some value there.
There is. I think I mentioned it earlier, that that's the area where you see stocks down 30, 40, 50%. I wouldn't say we're going all in yet, but there are some areas of the market of some very durable blue chip companies that everybody knows, many of which we've been underweight for a long time, where we've been thinking, maybe down 30, 40%, this isn't a bad time to be closing potentially some of these underweights. So we'll take advantage of it, but it's not kind of the shooting fish in the barrel type moment yet.
When the portfolio is put together, or as it's put together, and variances are looked at, something you've told me before is that you plan for different outcomes.
Sure.
I find that really interesting. Please tell our viewers about that.
Yeah, because if we're constantly looking at where is there too much bad news priced in. So that bad news can be a number of things. It could be based on geopolitical risk. It could be based on interest rate risk. It could be based on recessionary risk, or it could be something like the disruption, like AI within software. So those are the types of things we're looking at. And we're always thinking about, okay, we don't know what's going to happen, but it's nice to have a piece of the portfolio that might do well in certain periods of time or in some of those scenarios. So we like to sprinkle like some of these themes that we're hearing about into the portfolio, so that if it does happen, we have something that's going up while maybe a lot of the other stuff is going down. And if there's too much bad news priced in around that risk, and we own things that are there, potentially software, for example, if that keeps, if that bad news is already priced in, and maybe it's not as bad as the market thinks, then we'll get an outperformer. That stuff will start to outperform as the rest of the market comes down. The price is already baked into, or the risk is already baked into those prices that we purchased. We should do better than the market as that market starts to adjust to it, and we've already seen our prices come down.
So you've got a lot of levers you can pull depending on what does happen in the marketplace. Would you say that's really a key component to how you manage risk for the portfolio for investors?
Yeah, it is. I think I really go back to that simplistic model that we talked about. That is the best way, having that proper matching of income. Because what we've seen over time is that this strategy has returned roughly around 9-10%, with a little less than half of that coming from income. So if you have the income component, you're really going to be able to navigate a lot of different environments. And then you put the security selection aspect into it, and that really helps out.
Okay, and let's talk about a yield focus. As you were talking about the blend in the portfolio, what's the yield focus right now?
So the yield focus, so if you look at the portfolio right now, we talked about a little bit, or you mentioned a little bit, getting more neutral. So historically, we've had around, let's call it 20%, and I'll call it high yield credit. So think about high yield, leverage loans, preferred securities, CLOs. That's roughly been around 20% of the portfolio on average over time. Today, we're down around 5%.
Okay.
So spreads have tightened in quite a bit. So we're still getting a good yield out of that part of the market, but the opportunities aren't quite there. And that piece of the portfolio that today is around, let's call it 9% or so, we still have around a 9% yield, a pretty low duration, less than 3. So that's a good matching of income relative to the duration risk. But there's just not a lot of opportunities there. So as part of getting a little bit more neutral, we've been looking in areas of the market that we have not been before. So think about treasuries, that sort of thing. No investment grade bonds, because if we think about investment grade bonds today, most people say, oh, that's IG, that should be safe. But spreads are so tight there that you really aren't going to get any spread compression based on credit improvements, and you're really just taking on duration risk. So if I'm taking on duration risk, I'd rather just own treasuries relative to the IG corporates, where I have to take on that risk.
Let's go through the components. What's always been fascinating to me about Tactical High Income Fund is that there are a huge number of buckets within the portfolio. And the great thing is they're not finite. You have the opportunity to always look at what's evolving and what can be added with all the teams and inputs that you have. So let's start with what we know, or what I know so far, which is high yield. Let's start with that as far as where that sits in the portfolio.
Yeah, so I mentioned that's come down quite a bit. We've had... if you look at high yield spreads, I mentioned earlier, they're around 300. Not that long ago, they were in the 200s, right? So it's hard to find opportunities today that can give you 6-7% yields in that market. You really struggle to find, even in what I'll call the stress part of the market, triple C and below, yields that are that high. So that's an area where the signals are good, because the spread is telling us that the market thinks everything's okay, but the spread is also telling us that it's not very cheap. So on the lower end for high yield. On the floating rate loan side, the yields are a little bit higher, But within the floating rate loan side, we talked about this already, there is software exposure within that market. So we're being really selective. We don't have any software loans in there. We're focused on our loan team's best ideas. So think Bass Pro Shops, which we talked about, companies like that. So that's kind of the high yield and the loan pieces. Not a lot to do there right now, but still within our basket, we're getting a nice yield and a great duration match.
And last we spoke from a preferred standpoint, you were very specific there. It wasn't a
Yes.
large component of the portfolio, but quite specific. Same today?
Same today. So if we think about, we reduced the loan and the high yield piece, but over the last, let's call it 3 or 4 months, what did go up was the preferred piece. And the preferred market is mostly, the traditional preferred market is mostly banks, insurance companies, and there the spreads are also tight, not dissimilar to the IG market. But what we've been able to find is really unique preferred opportunities, so security selection. So folks might remember us owning the convertible bonds of a company that used to be called MicroStrategy, now Strategy.
Right.
We no longer own the convertibles and own the preferreds there, and the preferreds yield around 11%. And they're, that company, which owns a lot of Bitcoin, those preferreds are backed by the Bitcoin. And when we look at many worst case scenarios, we've got more than enough cushion there within the structure of those particular preferreds to be comfortable with the creditworthiness, will we get our money back, and also the income streams. The company's actually taken a bunch of cash and set it aside for just payments for these preferreds. And if you look at those preferreds over this last month, they've traded for between 98 and 100. So the volatility has been extremely low relative to the rest of the market. And if you look at the underlying common stock of that company, which is closely tied to Bitcoin. So we're getting some exposure to cryptocurrency there, but it's more of an income play and a spread compression, because if you think about if you had a bond or a preferred that was backed by real estate or some other asset other than Bitcoin, we still think that the spread for that particular preferred will be materially lower. So while it's been a great performer, we still think there's spread compression there as the market gets more comfortable with that type of asset.
Okay, I want to unpack that a little bit. So that was back in the summer, you made the decision. Can you take us behind the scenes on how you went from a convertible to a preferred issue?
Yeah. So we talk about investing across the capital structure at the top level of the fund, right? The different asset classes. But one of the things that our analysts do within the high income and alternatives group is they rate the full capital structure of the company. So they're taking that same approach, but doing it at the micro level, at the company level. So if folks will remember, back in the summertime, Bitcoin got up over 100K.
Right.
And we were having a discussion with our chief investment officer, Lionel Harris, and he was looked at that and what CIOs do, said, hey, this is a big piece of the portfolio and there's a lot of volatility here. Is that something that we should maybe consider looking at or just exploring more? And Adam, myself, the rest of the team, we had a discussion about it, said, you know what, that makes a lot of sense. Why don't we stay within the company? And they've got these preferreds, and at the time they were trading down in the low 90s. We can get the same company a much less riskier exposure, more senior in the capital structure, 11% coupon. That seems like a good way to stay invested in this company, but de-risk from a volatility perspective. And that's how we were able to do it. And if you look at the performance of last year, those preferreds were some of the best in the portfolio.
Some of our viewers may be saying, part two to the question that they're hoping I may ask you is, but at 65, whatever it is currently, maybe 65,000 for Bitcoin, is that an economic stress to the company? But you were saying that there's still a lot of cushion in there.
So when you look at these, the loan to value ratios on them are extremely attractive, like things you would see in the investment grade world.
Okay.
So you could see Bitcoin drop. I can't give you a particular number, but let's just call it materially lower from where it is today, and those preferreds would still be in good shape. Like I said, there's been a lot of volatility that as we've seen come down, as the Bitcoin prices come down, and in the last month, just volatility around that price. And what we've seen happen to those preferreds is they stay pretty stable in that $98 to $100 range. So it's tied to it, but with the way it's structured and how much is on the balance sheet at Strategy, we feel like we're in a pretty good position still. Okay.
We took a bit of time on that. It's not a major part of the portfolio, but certainly
it's
topical.
Important.
Yeah,
it's important.
Could we talk about gold? Any comments on that? It seems to be gold is disconnected from some of the risk in the geopolitical world because the prices come down, yet geopolitical risk seems to have gone up.
Yes. So gold is admittedly, we missed a lot of that trade within this portfolio. We did have a couple gold miners, but it wasn't a huge part of what we do. And part of the reason why we didn't own a ton of it, because we do a lot of work in trying to find who's buying the gold, right? There's nothing, it doesn't do anything. It's a store of value. So supply demand is the biggest driver of the gold price. And what we were seeing at first was that there are a lot of central banks buying gold. That made sense. That's why the price moved higher. More recently, it's been tougher for us to triangulate where that demand is coming from, which leads us to believe it's somewhat more speculative than actually hard assets being bought by central banks. So we never really chased that one. I think right now what you're seeing is just an unwinding of that, where you had a lot of people potentially speculating on the prices were going to go higher, and for whatever reason now they're pulling back. But we haven't seen necessarily the selling within the central banks that would be kind of the signal that gold prices were going down. So I think there was a little bit of speculation happening in that market, and then following that, the silver market too.
Yeah, so it may have gotten ahead of itself, finding some equilibrium now. It shouldn't be read as
100%.
A dire sign. We just have a few minutes left, so we'll go through a number of
Yeah.
headlines, and if you could give us your comments. Emerging market debt.
Yeah, not a lot to do there yet. There's most of that market is IG, but there are select opportunities. Again, we talk with our emerging market debt team pretty closely. Where we're invested today is in some the shorter maturity treasuries of Brazil in a local currency. So 10% will come due in January of next year. Low risk from a credit perspective, and if the BRL appreciates, then that's a positive. And while we're waiting, we're collecting 10%.
And U.S. Treasuries?
U.S. Treasuries. So we've historically, last few, let's call it quarters, have been mostly in 30-year Treasuries. That's starting to shift a little bit as we start to think about potential inflation impacts as a result of oil. But that's now a big part of what we have in the fund. And what I always say, and what Ford O'Neill always told us, is when credit spreads are tight, and that's in the high yield and the IG market, let's use the least amount of capital possible to build our investment grade duration. So that's why we're doing it with treasuries. And today we're slightly underweight investment grade duration in the portfolio.
You talked about convertibles with respect to the company called Strategy.
Sure.
MicroStrategy, as it used to be. But convertibles are a big part of the portfolio. The secret sauce, as Adam and you like to say.
Yeah.
Where do you stand today?
So that's just below 10%. We're waiting for a lot of new issuance. That is a new issue driven market. Last year it was a lot of these Bitcoin miners turning into kind of data centers. That theme has kind of played out. We don't know what the next theme will be, but there's about 30% of that market is either going to mature or come due in the next couple of years. So there's a lot of pent up demand. And the great part about the convertible markets, we just don't know what the companies were going to be. So what Adam and I like to say, it's like a basket of kittens, and we're trying to find these lions. We'll have to wait and see what the convertible issuance will be, but that's an area where I think we're excited about today. The biggest convert in the portfolio today is a company called Boeing. Folks know them. They issue convertible. I forget how long it was, maybe a year and a half ago, where they had some issues around the credit rating. They used the convertible to shore up liquidity, keep their investment grade rating, and it's been kind of a turnaround story there. So that's one of the convertibles in the fund now, but there could be other themes coming soon. We just need to see what happens, who's in that basket of kittens.
It was good of you to be able to admit that we don't know what's coming, but you know what? I know you're watching, and that's key. As we wrap, you travel all around North America in particular. You're talking to investors, you're talking to financial advisors. What are some of the key questions you're getting from them?
So we talked about a bunch of them: the energy, the software. The other one we always seem to get is, what's happening with the U.S. dollar? Is that the reserve currency of the world? And I think there's some the statements against the U.S. dollar maintaining that status. They make sense, right? We see what's happening in the world, and it's becoming a more global world. But fortunately for the U.S. dollar, most of our financial system is built around it. And that's globally, not just here in North America, globally. So unwinding that will take a long time. I think too, there needs to be a viable alternative. We don't quite have one there yet. So it's a risk, but it's something that, I don't think we're positioning the portfolio around, let's put it that way. But it's something we have to think about over time. And, for everybody who's saying the dollar was done, it was back over 100, the DXY the other day. So flight to safety, I still think the dollar and treasuries at this point in where we are from a history perspective on global markets is still the safe haven currency.
Excellent. So we'll conclude there. It's wonderful to hear that you, Adam, the whole crew have such a keen eye on all the different probabilities and outcomes that could be in front of us, but with a good, keen eye on risk as well. So important to investors and advisors. So thank you for that. Scott, it's great to have you here in the studio today.
Yeah, it was great to be here in person.
Wonderful.
Thanks for watching or listening to the FidelityConnects podcast. Now, if you haven't done so already, please subscribe to FidelityConnects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.